It's unplugged.
I think so.
Well, you're not doing it for 2 hours though, are you? I was gonna say, oh,
That's encouraging, right? Oh, man.
Well, there's just not that much.
There's
there's not that much in it, yeah.
We'll see. All right, well, we're gonna get going. I assumed we would have a smaller group today with UEA weekend going on with school and stuff, but although you know how it goes too, people will show up in the next 10 minutes too. But so anyway, so today is going to be the mortgage stuff where we're going to be covering mortgage. So Jeff actually is going to be teaching you and taking you through to let you know kind of what's going on that end of it, so you at least have an understanding of what's happening and things that way. So so I'm not going to have him come up like I usually do. So but wins or successes, what good things? Anything exciting happen? I know you got one. Share with these guys.
Got someone under contract.
You got his first under contract, which is awesome. So it's way cool. So, and is it what was the source of the client? Where'd they come from?
Friend.
It's a friend. Good. So SOI. Good.
Yes.
Which that's where honestly that's that's where we want our main source or our foundation. That's probably a better way of saying it, of our business needs to be built upon that. So good job. Awesome.
Buyer and seller.
Buyer. So good. Who else? What other wins or successes? What good things?
You know, I got everybody knows that my husband's a builder, and I'm following exactly the way you guys tell me to do this. Each little thing that I write down becomes more familiar, because I've never done this before, I've never had to. He's had other realtors, and now that I've moved into the path of his products and things, I'm filling out forms where I never knew how to fill out forms, so they taught me how to do that.
Awesome.
Now I was just on the internet looking at them, and I'm thinking, woo, that looks really great. You know, I like looking at
Yeah.
6 or 7 listings.
Yeah, which is, I'm glad you brought that up, because that's, especially since we've got, for the most part, newer here. What I have learned over the years is really the sooner you can get in front of somebody and write a deal, do a contract, the better off you are going to be. And because of exactly what you said, it gives you the confidence of, you know what, I can do this. That wasn't
Even being up on the 3rd floor with the gals, what are they called?
the TCs, the transaction coordinators.
TCs, yeah. Yeah, sitting with them and talking with them. I think that I'm gonna be in their office a lot more often and doing it by myself instead of sitting in front of a computer and figuring it out with them.
Yeah.
Is there a basket up there that you just put your things in? Is that the way you do it?
Well, typically, most of the time, it's just in dot loop is where people are doing it, rather than, but you can.
Yeah, I
just
think
take
I
it
was
up.
falling asleep through that class. It really
Went
did,
over
it just
your
went over my head. My
So
husband's
Russ
really
was
good
teaching
at it.
that then?
No, I wasn't.
I could not figure that out. And then when I got home and he was signing contracts with Dotloop, wait a second, I remember some of
Yeah,
that,
good.
even though I was falling asleep in the class.
I'll tell Marshall that.
I would try to, she's on the phone.
Just teasing. All right, good. Well, any other wins or successes? Rob's here, that's a win. Front row.
Front row, there you go.
Okay, so I guess, Joe, anything you want to share with for title?
Little title tip, yeah.
Oh, you guys
absolutely.
picked a
Thanks,
great day to show up on yours.
Rob. Nice time and
One of you guys took football.
That's right, awesome, good.
so, yeah, a little quick title tip. So last time I spoke about seller's proceeds. This time just a quick little tip would be whenever you have a buyer, for example, coming in, someone that has to pay monies, just know the difference with a wire, a cashier's check, and a personal check. So with the personal check, you can write it up to $500, no more. From $500 to $10,000, it could be a cashier's check, and anything over $10,000 has to be a wire. So yeah, quick little tip for you guys, okay? That might save you guys some hassles.
Okay, cool.
So, any questions
And that's on what kind of a check?
on any kind of transaction, real estate
Like earnest money?
transaction? Yeah, no, not an earnest money.
Okay.
Earnest money, earnest money can be
Yeah.
a check, but any kind of for the closing fees, it's anything that the lender has to source the funds on. So, yeah, awesome.
Cool.
Well, thanks, you guys.
Okay, awesome, thanks.
Awesome.
All right, Jason, Josh, come on up.
We got footballs.
I made sure to say Jason, because you know what, I actually talked to,
Jared, what was his name? What do you always tell me?
Justin.
Oh, you talked?
This just this week.
Oh, no way. Is he still doing what he's doing?
So he was actually talking to me about coming and doing like a training or something.
Oh, yeah.
So
Oh, nice.
awesome. Be cool. So anyway, all right.
Alright, so,
American
hey,
Motion.
are we live?
Yeah.
Do you record them?
Yeah.
Okay, we might have to ask for this recording.
Okay.
But,
It's on YouTube. You can find it. I'll
Is
tell you
it?
where to get it.
okay, sweet.
Oh, nice.
So we're gonna try, we were trying to think of different things, so we need 4 people. 4 volunteers. 4 volunteers.
You mean suckers?
4. We need 4 seconds.
4 seconds.
We need 4 seconds. Okay, come on, volunteer, good. Okay, so we got 3. One more. You want to be a sucker?
I'll be a sucker. I don't know what I'm sticking my foot into.
Okay, so what we're gonna do is, let's do teams. So you 2 on a team, and you 2 on a team. And you guys can use both your hands. You guys can only use one hand to throw the ball back and forth, and we're gonna do 10 seconds and see how many times you can throw it back and forth, okay?
So if you want it on video, you
we
gotta
don't use
scoot
one,
it.
yeah, so let's
You gotta scoot it a
So I'm
little
not so
closer.
great at throwing
But
football.
that's okay, you can go 2
Baseball
hands.
I'm better at.
Okay, so we'll do, hold on a sec, let me time it. Okay, so on your mark, get set, go.
So we just throw it to each other,
Yeah.
that's it?
Yep, that's right, it's easy.
Just use
to
2
do.
hands.
Okay, done. Okay, so
Football
how
shapes.
many did you guys get?
Did we count?
Did you guys miss at all?
No,
We're supposed to do this with our hands, did we
Yeah.
count?
Yeah. And how many did you guys get? Probably 6, okay, so,
And they did drop one.
and you guys dropped
2
2.
actually,
2,
right?
top,
Very
top, top,
nice.
They did, we did.
So
Exactly.
this
You
goes,
guys
Because
were
we're good at it. see?
Here's not perfect. So the whole thing we want to do is just take like a quick minute of your time. But we wanted to explain that the symbolism behind this is the football is actually the transactions that you do. And so we wanted to say your hands actually represent the warranty slash the tools that you have, your professional tools that you use to keep those transactions going forward. And the home warranty is simply one of your hands.
You don't want the ball to be dropped anytime during the transaction, as long as you have the warranty, you're protected and your clients are protected.
Exactly. And
How
so,
important is that?
so how important is that? You can simply, you did more ball tosses. You're gonna do more transactions with better tools, obviously. So you guys each team gets a football.
Enjoy.
So,
Oh,
yeah. So whoever wants to.
Yeah, you get an arm wrestle.
Yeah, you get arm wrestle.
So you're like, sorry, I'm keeping it.
Do you guys have is there any questions? Any experiences that we've had this past couple weeks with the warranty?
So there's a 1 year and a 10 year.
There's just, with us, it's
So
just
I'm
a 1
talking
year.
new construction, I don't know if it's the
Okay.
same on just
So-
existing.
So new construction is year 2 through 5. A lot of times they'll have a 1 year from the builder themselves, and then we actually take care of the next 4 years, year 2 through 5. With the home warranty for the new builds, for the
Yeah, so the
construction.
new construction covers, because the builder's gonna cover the first year,
Right.
then we cover years 2, 3, 4, and 5.
So where's the 10 year? Is there a 10 year?
There's not a team.
Okay.
Well, that's something that typically just the builder does, has
Okay.
Exactly.
And that's, those
Structure
are usually
for
limited
things.
warranties as well.
But on existing ones, I had one, and then this was a while back, but while I was under contract and I was listing it, the hot water heater went out.
Right.
And I put a warranty on there, and that saved my vacancy.
Oh, yeah.
And all of a sudden, and they came out and they said it's cheaper just to put a new one in.
Yeah.
So the people, they're coming in and they're seeing this brand new hot water heater being put in. I thought that was really neat.
And it makes you look, I mean, like you're the utmost of professionalism and everything else like that, you cover them.
And both the buyer and the seller thought it was.
Sure.
Yeah.
We actually just put one on one of Russ's listings yesterday. It's like the listing coverage is on there, and it said make sure that going through inspections that you're covered on all those main systems.
In fact, yeah, I just listed my mom's condo, and so yeah, I've told you guys before. I think of it as inspection protection. So,
Right,
I mean,
yeah.
it's in fact, I think I have that from Josh. But,
Yeah.
but anyway, so yeah, I put on the seller coverage just so that if something
Make
Put
sure
it
comes
up.
up. So
I put it on never missed it.
Yeah.
Good.
Well, you guys, we're here for you, so just call us anytime you have questions, or if your clients have questions and you don't know the answer. So we're here for you.
awesome.
Okay.
Okay,
Cool.
cool.
Thanks.
Thanks, guys.
guys.
All right, well,
Thanks for the football.
any other questions? Anything before we get going? All right, well, so Daryl, Zach, Sawyer, I'm gonna ask you guys if you'll slide up so that Jeff doesn't feel like he's like having to shout clear back there. So slide up. And I guess with that, I'm gonna turn it over to Jeff. I'm gonna actually sneak out and so have at it.
Okay,
He's gonna get you covered.
we're gonna talk about mortgages today. I have to tell you that if it's just mortgages, we talk about technical aspects of mortgages, you guys are gonna tune out. You're gonna get glossy-eyed, you're gonna go, look, I'm learning real estate, well, how much do I really need to know about mortgages? So what we're gonna do today is we're gonna talk about what exactly happens in the transaction, but more importantly, I wanna talk about why that's important to you. Because if I don't explain that to you, you're gonna go, I'm out. That's great, but it doesn't apply to me. The reason why this is important to you, and I've noticed this over the years, the higher the producer of a real estate, the more important their relationship is with their lender. And the inverse happens. The less productive a real estate agent is, the least important that relationship is. And I actually had a situation a few years ago that taught this to me really well. There was a guy that I had known in another situation. We didn't know each other as professionals. And we were sitting talking one day, and he asked me what I did for a living. I told him, well, we're in the mortgage business. He said, well, I'm in the real estate business. I'd known this guy for a while, and his demeanor immediately changed. And he says, I've never met a competent loan officer. He says, in fact, they are just absolutely one of the most disgusting professions I've ever seen. They can't predict anything that's going to happen. Why can't they just fix our deals and make them happen, blah, blah, blah. And it really bothered me. I mean, it wasn't just that someone had offended my profession. It was how in the world did he, who was a long-term professional, how did he get to the point where he felt that way? So I went out and did a little bit of research, and you guys know that in your profession, what you guys do, your production is public to a degree to those who have access. So one of our friends says, I'm curious, how much does this guy do? Well, I found that he did 4 transactions in the previous year. Only 4 transactions. And his experience with lenders was that they were the most incompetent people he'd ever met before. Well, how many of you guys have ever heard of the Pareto principle? You guys heard of that? Pareto principle. It's actually a famous economist 130 years ago came up with this concept. Yes.
80% of the business is done by 20% of the people.
Absolutely. 20% of your people, the top people in your profession, are doing 80% of the business. In fact, it's also called the champagne effect. It kind of looks like this. It's like a champagne bottle. And up in here, 20% of the people are doing 80% of those transactions. And those are the people we found have the greatest relationship or the most protective of their loan officers. Well, it was interesting to consider that, okay, if he did 4 transactions, where's he at? Where do you think he's at in here?
Down at the bottom.
He's probably right here. Okay, so the Pareto principle actually applies to most situations, most business relationships, most situations in life, most property ownership. And in fact, if this is the real estate profession, guess what the lending profession looks like? Looks just like that. 20% of the people in our industry are doing 80% of the business. So as alignment happens across these 2 professions, what is the natural alignment between us? Real estate professionals and lenders. Isn't it kind of horizontal?
Yeah, they both start.
Yeah. The relationships kind of happen like this. Okay, if you're up in here, and I gotta tell you, in both professions, we're talking 7-figure personal income. The person over here who's doing this kind of production as a real estate agent has aligned themselves with the person over here who's doing the same kind of production. Birds of a feather kind of a thing. Okay, so I thought, if I have the guy down here and he's doing 4 transactions, who is he seeing over here? If there's a horizontal alignment, he's seeing these people right there. And so is he wrong to state that our industry is filled with incompetence and boobs and those who don't know what they're doing? Probably not, because his visual says that's what that industry is filled with. So part of what I want to do today in teaching you guys about what's happening here is to help those, because this is a class of those who are kind of starting out, right? I mean, you're on the front end of this. And here's the reality about this principle. Where do you guys get dumped into this? You're right here for right now, and your intent is to go there. But for right now, you're right here. And if there's a natural horizontal alignment, you're naturally going to be exposed to the people over here in our industry. And I want to teach you guys how to not have to be exposed to this kind of people, because this is a very frustrating alignment. These people will fill you with a high degree of frustration. I want to show you how to maybe do these kinds of alignments here, okay? In our business, you guys are probably aware that in the mortgage profession, we have a lot of fires. You guys are familiar with that, right? The lending profession has actually gone through a mortgage crisis starting about 2007. We like to tell people it's very similar to what happened in the travel industry. For those of you who remember traveling 20 years ago, do you remember pulling up in front of the airport, jumping out of your car, and you can run down to the gate and kiss your relatives goodbye? Maybe leave your car running. It doesn't happen anymore. Okay, now it takes you 2 hours to go to the airport. Some days they make you stand like this and they're gonna take a picture of you naked. That's kind of what's happening in our industry. It's become a very difficult process to get funding done. Well, we like to say that what happens is a fire is gonna happen. I would say 3 out of 5 deals that you do, there's going to be a fire. Depending on the degree of it, there's going to be a fire associated with getting that loan done. And there are 2 things you can do when there's a fire. You can grab a can of gasoline, or you can grab a can of water, okay? And I've seen a lot of times where agents and loan officers bring a can of gasoline to that fire. And what does that do to our borrowers, to our buyers? Boy, blood pressure goes through the roof. Yeah, blood pressure goes through the roof, doesn't it? So here's what I want to. This is the why of what we're doing. As I help you guys understand what is required over here and how you can help this process move smoothly, you can get out of the natural consequence of ending up with the lowest producing until your business grows up. You can make this kind of a climb and align yourself with people who are a little bit better. So the way we do that is by bringing you an understanding of what's required to get through the process, so that when these things happen for you, you can become the person who comes with a can of water to that fire. So having said that, now I want to go through. Any questions on that? I mean, it's an unfortunate reality, but if you don't learn to utilize some of these principles, and the people you align with are on the low end of that scale, you're going to be set up for a huge amount of frustration. This guy I talked about earlier has been in the business for many years. Now, I don't know that you could say he was a full-time real estate agent. His production exposed him to the lowest in our profession. And he thought that they were incompetent and not capable of doing their job. And I can't argue with him. But he needs to expose himself to people up here. So the way we do that is understand the process. And when their fires happen, we become part of the solution instead of part of the problem.
And I'm in a little different situation than a lot of you. But I found that the fires happen even on the top of the top.
Absolutely.
And I've seen some of my deals fall apart right at the, last minute due to financing situations. And it's, some of it even, falls back on you, and you kind of want to blame somebody else. But if you haven't gotten all the information and know everything, where their down payment's coming from, and all these little tricky things, you'll watch your deal that you've already, you've got home, you've told your wife, or your husband, look, I got a $10,000 commission coming here in a couple days, it's ready to close, and I watched them
That goes away.
fizzle the day of closing,
Oh. It can happen
many
the day of
times, or get dragged on for weeks.
And you bring up a really good point. Even the people at the very best of our profession will have that happen. And that's what I hope to be able to explain to you, because how in the world could that happen? How can these guys bust your tail to get a transaction to the table? And a small portion of them are going to be cash buyers. So you get all the work, you put all the marketing, all the development of your SOI in place, you show them a ton of houses, finally write a contract with a cash buyer, schedule a closing, get your paycheck. Most of them are actually financing, which means that you got to come to a loan officer and say, here's my paycheck. Please make sure that I collect it in 30 days. That's a really tough situation. A lot of trust has been transferred to that person. So what we want to do is make sure that you become a part of the process of making sure at the end of that period of time, you're going to see a paycheck. So what I'd like to do then is take you through the process of what's going to happen so that you can see who's involved with this transaction. Obviously, the very first person involved with it is the loan officer. What you guys have generally done is you're on the front end of pretty much every transaction. On occasion, you'll see some transactions come the other way to you from loan officers on occasion. For the most part, you guys are on the front end of it. They're your client, they came to you, you guys are the captain of the ship. And when they come to you, generally, it's becoming a little bit more different in this day and age, but they need to have financing put in place. So the thing that you have to do first and foremost is say, are you a pre-qualified borrower? Because nobody wants to write an offer to someone, have them tie up that property, put earnest money on it, find out that they don't even qualify on the front end to buy that house. So what you do at that point is you call your loan officer. That's the first person our end asks you to take a look at this deal. And the loan officer's obligation is talk to the client, gather financial information, pull their credit. Now, when I say we gather financial information, we need to see 2 years worth of tax returns with W-2s. We need to see 2 pay stubs with year-to-date income on them. And generally, we need to see 2 months worth of bank statements. So we're going to gather that information from them, and we're going to take that information and pull their credit. Now, you guys have a pretty good idea of what credit looks like, right? It has become a FICO-driven business. I was doing this before FICO scores were even being used. We just looked at the credit, made a determination. It wasn't so easily understood that that was going to happen, but in this day and age, they look at that FICO score for everything. So we pull their credit. Now, in order to pull their credit, we have to have authorization. So we're going to have them sign a release that says we can pull their credit. We're going to ask them to submit to us the financial documentation. If they can't bring it directly to us, we ask them to submit it in a secured site. It's actually required of us to use those secured sites because this is very sensitive information. Now, when we have, there are 5 items, and once we have these, and we have to have their name, address, social, credit, and an address of the property they're going to buy. Once that happens, we have to send out what's called an LE. It's a loan estimate. We have 3 days to send that out. Go ahead.
So, I generally don't go, I won't have an address, because I won't even work with the buyer until I have a pre-approval letter.
Right.
So I won't even show them a house. First thing I do is I call up my loan officer who happens to be with Citywide, and I say, Mike, I need a pre-approval letter on these people. And then I put them in touch with each other. And then Mike calls me and says they're approved for up to
Right.
240, 270, 500, whatever. So I never ever give an address.
Well, and I probably jumped ahead of that a little bit because you're right. We ought to talk about that commitment letter a little bit more.
Oh, appreciate it. Touching back on to pre-approval and qualified, I think it would be beneficial to talk about the differences, because there are many times when these folks may call a lender and get a something very quickly because
Pre-approval.
maybe they're looking for something.
I mean pre-qualified. This is
Right.
when they get right.
But that isn't something that when I have a listing, that doesn't do it for me.
And it shouldn't do it for you.
Yeah, so I don't know that these folks will know the difference, and I'd like you to touch.
Yes, the pre-qualification literally means nothing to you guys. Pre-qualification I can actually do on my phone while I'm driving down the road, although don't do that while you're driving down the road. But basically what the pre-qualification means is that I have taken your income, looked at your expenses, added a house payment in there, and it fits within the qualifying ratios. That's all it is. I'm doing a math calculation.
Okay, so when we're with, I haven't ever done this, so when we're with the client and we're saying they need to see a loan officer first, you said there's 5 things that we need to let them know that they've gotta take to the loan officer. Other than their name and address, you saying address or
Right.
not address? So what are the other things too?
So I need to get their name, address, employment information. Name, address, employment information. It's easy when I go down the application. Name, address, employment information, address, and age. I think it's the age is the other one.
birthday.
Yeah, birthday. Yes.
I generally will say, I mean, because I want to work with my loan officer, and I explain to them, I have someone I've worked with that I've been able to, there's gonna be kinks along the way, and I've been able to, and I work well, I'm gonna have my loan officer call you in the next hour or two, usually, and they're gonna get some information from you. So I trust this guy, and sometimes they'll say, look, I've already gone to my own bank, and that's fine too. But if they haven't, I say, you know, I really work well with this gentleman, and we've been able to get through a lot of fires together, and he will.
And that's important to have that relationship.
And I have the loan officer call them. So when he calls you,
Yes.
don't be surprised. He's gonna ask you some personal information that I don't even wanna know. You know, it's none of my business.
Yeah, it's great to be proactive on that, because you should call your loan officer and say, please follow up with this person.
Okay, so they get a slip of paper that says what they're qualified for.
Okay, so
Am I jumping ahead?
just a touch, because
Okay.
I wanted to kind of explain that most people, most real estate that's been around for a while, realize that a pre-qualification is basically nothing. And in fact, a pre-approval, if not done properly, is also nothing. So I want to explain how that works, because what we do with a pre-approval, so after we moved on, if someone gives you a pre-qualification letter, that means absolutely nothing.
If I have a listing and I get a pre-qualification letter, I'm gonna call the lender before I ever accept the offer.
Just to verify it or what?
No, it means they really haven't done anything. And
I need
here's
to
the
know where we
difference.
are because I need to know how long we're gonna need, I need to know what the initial payments were. From
Here's the difference. The reason why is because a pre-qualification letter basically says, I've done the math. Mathematically, you can buy this house. But what we have not done is pulled their credit. We have not done an AUS, which is an automated underwriting system, which plugs those numbers into a formula that kicks out conditional approvals. So if they give you a pre-qualification, just done the math. Pre-approval, on the other hand, I've now gathered their documentation and reviewed it. I've determined what their actual annual income is. I've taken that information, done as much verification if I need to. Now, sometimes the information they give me creates more questions than it provides answers, and I have to do more digging at that point. So sometimes a pre-approval that has validity might take longer than a day. If we're looking at it and go, wow, this is right on the edge. Their credit score is not great. I've looked at their income, and it's just they've had 3 jobs in the last year with too many gaps. For me to tell you to go out and sell these people a house would be not the right track to go, so give me a little bit of time to go farther into this. Because there are many different levels of pre-approval. For instance, if I pull a credit on someone and they've got an 810 FICO score, they bring me W-2s and show they've been on their job for 10 years, I can see look at their bank account and they can put 20% down on this property easily, I'm writing them a pre-approval letter. Now, on the other side of that scale, I've got someone with a 621 FICO. They've had 4 jobs in the last year with 3 gaps in them. They have absolutely no money down, so they want to take advantage of a 100% lending program. I am not going to sit down and write a pre-approval letter. I'm going to take the information that they gave me, walk into my underwriter and say, please tell me what you see the income is and what the deficiencies in this file is. And then once you determine those, I would like you to run that through the automated underwriting system and give me a kickback of a conditional approval. Now I can take that to my seller, to the real estate agent, and say, these people are approved to buy, subject to no changes in that property, free and clear title on the house, and an appraisal that substantiates the value.
So did their FICO score go up? Is that why you can?
Well,
pre-approve
we
them?
can do things like that. I use 621 as an example because at
That's very
620
low, isn't
is
it?
very low. FHA, however, will allow us to go down to 620. There are some people who advertise they'll go down to 580. You're in for a struggle of your life because they're not really going to do that low.
What would prompt you to do a pre-qualified letter? Somebody's in a real hurry and you wanna hope that somebody on the other end doesn't know where it is?
I will never do one.
Okay,
It means nothing.
so if you got a listing that's pre-qualified, you probably want to be real careful.
Yeah, I would never do
Especially if you
a
got
pre-qualification letter. It means absolutely nothing.
So what do you tell your clients to do? To
Get a
go
pre-approval letter or a
Get a
letter of
pre-approval?
commitment. Now they're called both of those. They're the exact same.
pre-approval and what?
A letter of commitment.
Okay.
It basically just says the borrower is saying, I've reviewed this information, I found that they actually fit the criteria, go ahead and go show them a house, I feel really confident that they can buy this house. Now, having said that, you brought up a point, I get all the way to the end of the closing, and all of a sudden the deal falls apart. Why did that happen? Well, this is the reality of the process. We have gathered as much information as we could on the front end, and we have a snapshot of what their condition looks like, from income to credit to down payment, job. And as we start digging into things, sometimes more questions appear than answers. We have this happen all the time with bank accounts. All of a sudden there's things going in and out of there that cause a lot of concern. We started looking at their job and they took 3 months off last year because they wanted to do something. And all of a sudden we have more answers, we have more questions than answers.
I had someone go buy a car a week before.
Yeah,
A week before their closing, they went and bought a car, and that threw them out of
Right.
the range. And
Right.
they'd have just waited a week, they'd have had the house, and they could.
And we try our best to warn people, please do not change. In fact, our commitment letter, our letter of approval states in there, do not change anything about your income, employment, or credit.
we're spending.
Yeah,
So
the
you're
credit
saying
is actually
that
part of that.
usually comes up with a lot more questions than what you, is that
Not
something
always.
that you really didn't want to look at? You was hoping that you wouldn't be seeing all this extra stuff?
Yes, that's more a situation of 10 years ago. Right now, so many eyes are looking at that file before it actually closes that it is virtually impossible to not find an issue that is an issue. It's virtually impossible. In fact, that's part of what we're gonna do is talk about the people who are involved in this process and how many eyes are looking at this. So in order to get past them, it's going to be found out.
So how long is a bankruptcy on there for 10 years?
Well, bankruptcy has relevance for 7 years to us, depending on the program that we use. For instance, like conventional, it is a 7-year waiting period, but FHA will actually go 4 years, and sometimes with extenuating circumstances, we go 2 years.
Depending on which bankruptcy?
Depending on, yes, exactly, or the circumstances behind the bankruptcy. If a bankruptcy is a consequence of terrible living, terrible credit management, then more than likely, you're not going to get any leeway. But if bankruptcy comes on the heels of wonderful credit, all of a sudden I lost my business, all of a sudden my wife ended up in the hospital, one of these things happen, then they go, okay, those are extenuating circumstances. We're gonna take a look at that bankruptcy differently. Now, conventional means the conventional financing doesn't really care as much as, say, FHA, VA, those kind of things have a lot more sympathy for the manner in which you took out your bankruptcy. So, when it comes to bankruptcies, we've got things done where I just shook my head and went, wow, that's amazing, glad we got it done. Same thing with foreclosures. In the scale of relevance, actually, lenders look at foreclosures as a worse occurrence than a bankruptcy. We're lending money on a house. So you could have a bankruptcy because of your health purposes, but from a lending standpoint, we want to make sure that every single person recognizes that the most important thing in their life is their mortgage. Let everything else go, but maintain your mortgage. Right or wrong, that's how it's viewed. So, anything else, any other questions on that? Yeah. So that is the primary responsibility of the loan officers, to gather those documentations and make sure that we feel confident in being able to write that letter. Now, we have to, at this point in time, because of all the changes in the mortgage industry, we have to make sure that all kinds of disclosures have been taken care of. We have to have, on the very first, we have to make sure we have authorization to pull their credit, a signed authorization.
Where do you get that from?
From the borrowers. There is also, we can pull the credit on an implied authorization, which an implied authorization means that you gave me every single thing I needed to pull your credit, and where did I get it from? I have a record of a phone call with you, you gave it to me, I pulled your credit. I still have to come back to you after the fact and get a letter signed by you saying you authorized me to do that. But at least by talking to you on the phone, I can expedite the process. So we're gonna have that done. We're also going to have them sign an e-consent. E-consent means that I have the authorization to have contact with you throughout the entire process by email. If I don't get that e-consent, this becomes a longer process. In fact, 30-day closes are going to be very difficult. I can just assure you, 30-day closes are going to be very difficult if your borrowers do not have an email or won't be able to. And actually you do on both borrowers. Okay, so once I do that then, and I have gathered the information here and I now have a contract, you guys have given me a contract, okay, we've jumped ahead a little bit, you got your commitment letter, went out of house for them and wrote a contract on there. A couple things I want to mention about contracts. In this day and age where we have waiting periods that are mandated by federal regulation, if you're writing less than a 30-day contract, you're asking for difficult. And if you have a difficult file, meaning the borrower has a lot of issues on it, or that property might be an urban property and may have ingress egress issues, if you write a 30-day contract, you would better prepare your seller so that they don't get to the end of that and say, I'm taking my rent money and run. This could be a more difficult file. So be prepared for that. But having been given all that stuff to us, now we have 3 days in order to give the LE, the loan estimate to the borrower. And in that loan estimate, we're now going to disclose the cost of doing a loan. And within that cost, we have, as a lender, we have zero tolerance to change those loan costs. Zero tolerance. There's a thing called change of circumstances. If something, there's only a few allowable instances in which we can change those fees. One is to change the property or increase the loan amount. But if the loan stays the same, we cannot change those costs. And that was one of the best things that the federal regulators did to protect the borrowers. If any of you know or have bought homes 10, 15 years ago, it was possible to show up to the table to close your loan and not know what your fees or your rate was. That literally happened. You talk to title people, they'll tell you we were the ones telling them what their interest rate was in some cases when you had irresponsible lenders. So when we send out an LE on this end, we're telling them what their fees are and they have to stay the same. And when you get to the closing table, the new HUD, closing statement is what we call it now. When we get to that, part of that process of signing that is that on the third page of the closing statement, we're going to compare the costs that I told you it was going to be and the costs they actually were. And I have this much tolerance. In fact, if it goes down, I'm okay. If it goes up, I have that much tolerance. And I have to explain why. And in fact, I don't know how much of this information, I won't overwhelm you guys, but I want you to understand what we're dealing with here. Third-party fees, which is title, appraisal, inspection, those kinds of things, actually have a 10% tolerance. So if they come in a little higher than what they stated on the beginning, that's fine. They can allow those changes to happen, get to closing, and they'll make allowances for that. Nonetheless, we're going to check and make sure that what we told you on the front end is actually what happens. So we have 3 days to send that out. They need to sign that document. They need to they need to acknowledge that they received that document. Now, we cannot order an appraisal until that's signed. So you may have a rush and say, okay, hurry and get your stuff over to the loan officer and let's get that appraiser right out there right away. Cannot be done until they acknowledge those things. Okay, once they've done that, then we can have the appraiser go out. Now, what we're seeing right now, and this is an issue that I hope our industry does something about. We have a shortage of appraisers. It's a national shortage. In fact, you talk to the people who are out there, this is going to be a huge issue coming down the road. The reason why, and I'm not an appraiser, but to become an appraiser now requires educational process very similar to a bachelor's degree. Then once you've received that, you now must intern, I think it's 2,000 appraisals, but I'm not an appraiser, I don't know, don't quote me. That is what's required now to get in to become an appraiser. And once you become the appraiser, you no longer get to operate autonomously. You must align yourself with an appraisal management company, an AMC. The appraisal management company acts as an intermediary between us, the lender, and the appraiser who they claim we used to unduly influence. So they've created this company who protects them from being influenced by us. For that protection, the AMC is going to take $100 to $150 on an appraisal. So now it's harder to become an appraiser. You actually have to do more work and you get less money. We're not replacing those appraisers. 10 years down the road, there is going to have to be a change, or we're going to have a drastic shortage of people doing appraisals. And right now, you may be people who are in the industry and have actually been out there doing transactions, you'll find that the appraisers are taking twice as long as they did 3-4 years ago. We're seeing in some cases 10 business days.
Okay, an appraiser, are they giving really poor appraisals on houses now? Are they keeping it really low or something?
Okay, that is
I
a
know,
great question.
Is this another,
No,
area that
that is
I
a
don't-
great question.
okay.
It's a coin toss.
It is. Now, here's what's happened. Because they have protection, there is no more undue influence. In fact, the way this used to work, me as a loan officer, I could call up my appraiser and say, I need this appraisal done, and this is what it needs to come in at. We'd have the conversation, you go out and look at it, come back, oh, you don't have some problems here. I go out and find additional comps and say, please bring it into this value.
So you're telling him what you need that
Yes.
appraiser is, and
10
he's
years
like,
ago,
okay,
10 years ago.
10 years ago.
I
Well,
used to meet them at the house.
yes,
I used to help.
Yes.
yes.
Here's what we gotta have this happen.
And then,
5 years ago.
yes,
But
Part
I'm
of the
hearing a
mortgage-
but in here.
yes. Part of the mortgage meltdown was they blamed a majority of the meltdown that happened in 2007 on appraisers.
For appraisals.
Yes, because they felt like we, and I'm talking about loan officers and real estate agents, influenced the value of that appraisal by putting pressure on that appraiser to bring that value in, or we'll go somewhere else. Now, this is on, I never did that. But that was part of the reason why we have so much regulation in the appraisal industry now, is because people influenced the higher values and they just started escalating. When we saw the rapid increase in values, appraisers had no problem keeping up with them. Well, you guys have seen this year, we've seen appreciation happen, and the appraisers have not kept up with it because of the stops they put in place. So now there's a protection to an appraiser for us to go out and influence him with the threat, if you don't do it, we'll go somewhere else. They work for the AMC, they don't work for us. And in fact, VA has taken that completely out of our hands. We don't know who the appraiser is, we don't get to contact him. We have to wait on their schedule for the VA appraisal to come back. Those of you doing VA homes know that fully 1/4 of VA appraisals come back lower than the purchase price. It used to be when you took a client out and they determined they were willing to spend $250,000 on a house, the appraiser tried to substantiate that because you know more about the value of a house than he does. That's not the case now. So be aware that as this process goes along, I must gather all the documentation, disclose the cost of the loan to the borrower. They must sign, acknowledge those costs, get it back to me, and then I can order the appraisal. That process there could take weeks, 10 days.
So you're the one that gets the appraisal, or who, so it's random,
order it.
you don't know who the guy is. You just call a company and they assign.
Well, we align ourselves with AMC. The AMC allows us to build pools of appraisers, but the pool has to be a random allotment. So that we have some people in our pool, but we do not get to choose. It is a lottery pick. We do not get to choose.
Luck of the draw.
Luck of the draw. So that if you're looking at the process here, we go, okay, hey, why are we at 30 days to close a deal? I could be 10 days here. I do everything I can to make sure it's not. And then I have to go up to 10 days to wait for the appraisal to be done. So by the time the appraisal's done, I'm 20 days into this process. You guys have written an appraisal contingency, finance contingency. We could be out here before the appraisal's back. And now we have 10 days to close it, and we finally have everything that we have, and now we have to go through the rest of the process. It becomes a very difficult fight sometimes to get these things done. So that's why we're explaining here, why is this important to you? Because the natural inclination as a real estate agent is to be, why don't you have this deal done? What has taken you guys so long? Well, that's what this class is about, an understanding of the process. Because you would love for us to say, okay, I gave you this, now this is the next step. Well, we have mandated checks along the way that we can't bypass. So that's what happens here. We get to this point. I've done all these things. I've actually introduced at this step now. Once I gather that documentation, I want to be out of the process, okay? Because truthfully, I'm a loan officer. Really, I'm a salesman, okay? I'm trying to drive business through the door. When it gets through the door, I want someone who's a lot more competent and organized than me to take over the process. So at this point now, I've got what's called an LOA, or loan officer assistant. This person takes over the job of gathering and verifying additional documentation. So when I give that to them, the documentation the borrower gave me, now, this is what it looks like. a 1003 is an application for mortgage. We call it a 1003. It's a HUD assigned number. Every single thing they tell me on that form, every single thing, I have to re-verify at least once. Everything. So they brought in their documentation, they brought in their pay stubs, they brought in their W-2s and tax returns. Guess what I have to do now? Okay, so their income that they brought me from their job, I now have to request a VOE, it's a verification of income. Okay, that falls under the loan officer's responsibility. They're gonna request a VOE. They gave me tax returns. I have to have them sign a 4506T. It is an IRS form, and with that form, I have to receive copies of the tax return they filed with the IRS. The one they gave me isn't enough. I have to verify that they sent that return to the IRS. Now, on that 4506T, they come and take the application and tell me their name is John T. Smith. I put John T. Smith on the 4506T and submit to the IRS. The IRS says, it's John T. Smith. I'm not going to give this to you. I just spent 8, 9, 10 days finding out that I don't have the exact name on the request as is on their tax return. Now we have to start that process over. So you can see how this can be kind of convoluted. This is a step, this person handles gathering of information that has to be done right, and it has to be accurate.
What's the VOE stand for again?
Verification of employment,
Employment.
yes.
One of the toughest people are real estate agents, to get along for. Because our income can, 1 month you can make $60,000.
That's right.
And the next month you make zero.
That's right.
And it's tough to verify and
You're exactly right. We may look at that, so we send out a verification of employment. It's going to ask for your last 2 years and this current year. And we're gonna look at that and go, here's one of the things that kills underwriters, declining income. Declining income says, I'm actually not doing as well as I used to. I'm a candidate to not make my payments. So they're gonna look at those information, that verification of employment, and if it shows that their income is declining, or there's a box on there that says, what's the likelihood of their continued employment? And if they don't put high on there, that very likely could kill the deal. Okay, so think about this. Up here, I gathered their pay stubs, their tax returns, their W-2s, and everything looks great. I go down here, the LOA went and did a verification of employment, and it comes back and says, not a high degree of likelihood of continued employment. In fact, their income is declining. Okay. This could be 10, 15 days into the process before I receive all of those verifications of employment back. We're not the first, where I told you, where you came to me and gave me the information, I gave you a letter of commitment the next day. Now we went to verify their information and it's not accurate. So now down the road, all of a sudden, and that's why you guys give us finance contingencies that are down their ways, because as we're gathering this documentation, it may not reflect at all what they said it was. So that's this person's job, is to gather that documentation. Okay, now every step along the way, it's not that we've given you a yes, we just haven't told you no. That's what this process is. We're just saying here, it's not a no, proceed. This next step, it's not a no, proceed. Okay, next step, the person right here is the processor. I'm not a very good writer on a board. Processor actually now receives what's considered to be a really fully itemized lending package. Now, this package could move to this process here without a few documents, but we have to have a really good reason why we would continue to work on it without those documents. One of them might be, let's move it along to processing. I don't have the appraisal yet. But I want you guys to start looking at it because we'll do a credit, it's called credit approval. It doesn't have the property on it. Property is hugely important. There are a lot of things about properties that can kick it out of financing. But we can move it along to that step, but we really prefer to have it looked at by a processor with the appraisal in the file. Otherwise, there's unknowns. We just don't know what's going to happen down the road. So we're going to give that to the processor, and we actually ask of our processors within 24 hours to submit that to the underwriter. Okay, so they are going to, what they do is this is This is another set of eyes that's gonna look at it. A more trained, more professional person than up here.
Licensed.
Licensed, they've been highly trained. We put a high degree of faith in their ability to determine whether or not that file is worthy of additional work. We can't devote very highly trained, very highly paid individuals to processes that haven't gone through vetting. So this person here is going to make sure that the documentation that was asked for, she feels confident that when we submit that to the next step, we've done enough work to make sure it's worthy of our time. So she knows what the processes look like. She has a great understanding of underwriting guidelines. If she doesn't know them, and I'll tell you, underwriting guidelines, though they're certainly not as comprehensive as the law profession, it's kind of like that. Though they change on a regular basis. It is virtually impossible for any underwriter or processor to understand all of the underwriting guidelines. They change on a regular basis. So, but they understand where to find them, and that's what a lawyer does. Where are the laws at? Where can I find precedent to make sure this will go through? So that's what's happening here. So anyway, it now is being passed along to the underwriter. And the underwriter is the person who, they're the ones, you guys know this, they can make the A or nay on the loan. It's good enough, let's actually do the deal. Generally what happens though, is it goes to underwriting. Underwriting takes a look at the guidelines and they say, we have deficiencies in the file. Or there's areas that I don't understand enough, you haven't actually documented sufficiently, I need these additional things. So it'll come out of underwriting. This process here, we ask 24 hours of the processor, get it off your desk and get it into underwriting. Underwriting can take 48 to 72 hours. In a really busy environment, it could take longer. So what we like to see here is 2 days, 3 days most. Because as we're going down this list, there are fewer and fewer of these people. Okay, our entire company, we did last month, I think we did 1,500 loans, and we have, I think the average underwriter is doing 75. So this is a very highly trained, very highly paid profession right here. They're the person who can actually make or break a company. They could approve a loan that should not have been approved, and it comes back to us and we have to repurchase it. I mean, we can go out, fund a $300,000 purchase. We send that along to the aggregator and they say, there's deficiencies here, we're not buying it. We pull $300,000 out of our pocket and buy that loan. It is not a good situation, but that underwriter has the ability to make the final say on whether or not we're going to do that deal. Now, at some point in this, and it doesn't actually have to happen, it can happen before or after, our company has instituted a person who is actually responsible for quality control. Quality control is another set of eyes that's going to go through and make sure, because we're putting a lot of pressure on our underwriters. We want them to get that in and get it out. This is the determining factor as to whether or not we're going to do the loan. So we have another set of eyes called quality control that takes a look at that file and says, I've also looked at it, T's are crossed, I's are dotted, and make sure that it actually should have gone to this process, to this stage, and it gets done. So this QC person is a very vital part of ours. Now, this is not mandated by the industry per se, but in order to protect us from buying loans that shouldn't have been bought, we've instituted that step in that process. So they're looking at this file while the underwriter is determining whether or not we should proceed, or if we should proceed, what additional conditions need to be met. So this will come out of underwriting, and like I say, we try and stay at 2 days, 48 hours, in which a conditional approval comes out. That conditional approval, depending on how well we did our job here, and a lot of times how well we do our job here is dependent upon how strong the borrower is. Sometimes we get so much pressure from our loan officers, from real estate agents to say, get this done, get it done, get it done. And we're looking at it going, we need a lot more information, but let's move it along the process. We'll shoot it down to this step right here. That deal could come out of underwriting with 50 conditions on it. We have to then go forward and meet those conditions. Now, those conditions fall into a group, a varying group of importance. We have, it's called PTD, or PTD, PTF. Let's think if there was one more, but PTD is prior to doc. So conditions have to be met before we will draw documents for you. These are of vital importance. PTF is a prior to funding. meaning that it's not that high of importance. It's got to be done at some point between the time you close that transaction and we fund it. Now, you guys know in your contracts, there's a default of 4 days in which from the time you close it till the time it needs to fund. But as you also know, there's a lot of pressure on us to fund it right then. Funding is actually falls into a couple of categories. One is called a wet fund or a table fund. That's when we actually close the documents, we hurry up and review them. And we've got people running to review those documents, and we're gonna fund that thing the same day. In some states, that's a law. It's not a law in our state. I don't have a big problem with doing table funding, wet funding, because what it makes us do is do the work that's called PTF, makes us do that PTD, and it gets everybody to the closing table and get their keys quicker and get you guys your paychecks quick. But those conditions have to be met, no matter what. So she's the one who's gonna, when it comes out of here, she's going to have categories of conditions. PTD, we're working on right now. We're calling the borrowers, please go get us this documentation. We absolutely have to have it now, sooner the better. We're going to whoever's involved. It may be an employer, maybe a bank, it may be someone associated with the appraisal. A lot of times we have to have the appraiser explain things on the appraisal. Many times we have addendums to appraisals. Many times we have addendums to Rep Cs. This is an issue that I think you guys are probably being taught a lot, but the standard Rep C, that's 6 pages, right? The standard Rep C is basically fill in the blank, to a degree. The addendums are where things get a little bit hairy. And what you write on an addendum and give to us, and we have to have those addendums. We have to have an underwriter review that addendum and make sure that the wording in that fits with the underwriting guidelines. Now, here's where you guys can be tremendously helpful to us, because there are many times that we get to this point here. We've met all the conditions, we're ready to resubmit, because we're gonna do a resubmit to an underwriter after we've gotten all the conditions. We're ready to resubmit, and I can't even count how many times this has happened. And you guys know how addendums are done. You write an addendum that changes the terms of the contract. And we'll get here, and all of a sudden, I get from the real stage, and I get addendum number 6, and I go into the file, and I have 1 through 4. Do I have a problem?
Yes.
A huge problem. And so we've got people screaming at us to get to this point and close this deal, and all of a sudden I'm missing addendums. And in many instances, recognize this, it's not just that I'm missing an addendum, the underwriter has not reviewed it. Meaning what you wrote in that addendum could potentially kill that transaction. You've gotten all this way down here, and all of a sudden we have an addendum that the wording says such and such, and we're like, we can't do that. Some of the things that will absolutely either kill or just generally delay are repairs to the property. We've agreed to do this, we're gonna put a roof on it. Well, and you're gonna come to me and go, well, can't we just escrow that? The answer is, unless there's 3 feet of snow on your roof, no. You cannot escrow that. Now, whatever time you thought we were gonna actually close that, and a roof is extreme, but there are many things that are repairs to property. We're now going to stop everything dead in its track, and we're gonna go out and fix that.
Okay, so you're saying that you can't fix it later on, escrow it. What if it's like snow and the driveway is chipping or
Yes.
something? Okay, so you can't redo a driveway, so can you escrow that?
Yes.
So people can get in?
Yes,
So those are some of the things written on the addendum you're talking
it's
about.
real simple, weather-related escrows. So if I can't get in to repair my driveway, I can't get in to repair the roof, I can't get in to repair steps on a porch, then I can do a weather-related escrow. And in a weather-related escrow, we're going to take 1.5 times of the cost of repairing that item, and we're going to put it into an escrow account.
Why 1.5? Is
Because
it a
we-
protection?
It's a protection. Things,
So
your husband's a
after-
builder, right?
Right, so
Never
if
comes
you
in a
paid
cost.
for it with the one, what happens to the other half?
It goes to whoever had that come back, because it's generally
Okay.
gonna be the seller. So the seller's gonna take 1.5 of their proceeds, put it in an escrow account, and make sure that stuff gets fixed. Once it's fixed and everybody signs off on it, and our underwriter has to sign off on it, the appraiser has to go back, verify that that's done. We have to send that addendum, appraisal addendum, to the underwriter. She agrees that it's done. Escrow now releases funds to the contractor, and the difference goes back to the seller.
Does an appraiser have to go and look at it?
Yes.
Can't a receipt show? A receipt's not good enough.
Unfortunately, no. And the reason why, these are great questions. The reason
I'm
why,
probably asking more than what the room
I think that you
wants.
guys are probably thinking the same thing.
Alright.
The reason why their answer is no, and it's a firm no, is because pretty much any item that's been put into the loan process is to combat someone who tried to circumvent the rules. So as you can well imagine, it's not that hard to go out and get a contract to come out and throw everything and say, I fixed it. And it's not fixed.
Oh, yeah.
And suddenly we've got lawsuits on our hands. Because here is a very vital bit of information, and you guys probably know this through many, many years of experience. When money changes hands, urgency is gone. People will not comply with your requests when the money has changed hands. Many of the rules that are put in place from a lending standpoint, of course, obviously, they're set to protect the lender. Most of those rules are set, a lot of those rules are set to protect the borrower. So as you can see, someone goes in and says, yeah, I just got in my house, let's get the funding done. Yeah, I did the work, I'll do it next week. Money changes hands, everybody's just happy as can be except for the home buyer, and they don't have their driveway repaired. So the way we ensure that is an appraiser who's licensed and bonded says on the bottom of his addendum, I have inspected this property and it fits the required repairs. I authorize the release of those escrow funds.
So are those two separate, okay, so you have to pay an appraiser to come out to look at the cement?
Reinspection, it's
Yeah.
part of the cost. Now it's generally gonna be
There's
set
not
up,
like one lump sum for an appraiser to come out and take care of things? So
unfortunately,
each
no.
little time that they come and go, you have to pay for each? Ah,
Your husband's a builder, every time the bank comes out, they pay an inspection fee. Every time. The reason why is because the appraisers are doing more work now for less money than they were 10 years ago. If they gotta go back out to that property, then somebody's gotta pay for that inspection. Now, that, if we don't put that into the cost breakdown, we cannot cover that in the, as a lender, we cannot cover that. We have to have that in our cost breakdown. So if something shows up late at the end of the day, the truth of the matter is, and as you guys as agents need to make sure that the real estate agents understand this, we're putting 1.5 in there. 1.5 is going to pay for the repair, and it's going to pay for the inspection. That needs to be understood. You guys are professional negotiators, and it's your job to anticipate that there are going to be additional costs and who's going to bear those costs. Your Rep C tries to address those issues. They try to get you to consider these are the things that have generally come up in the past to make sure that we address them. Like for instance, an FHA allowable repair, what's that called? How much money is allowable if your FHA requires repairs on it? And you have to put a number in there. Either put NA or you put a number in. Most of you put $500. We will allow $500 of our seller's proceeds to go towards repairs if an FHA appraiser mandates that they're required. So as the negotiator, you guys are professional negotiators. It is your job to anticipate those costs.
so that's a cushion.
It's a cushion. Now, because you're doing 1.5, you're hoping that it won't cost 1.5 and then the inspection fee will come out of that. Okay, so as you can see, we get down to this step right here. There are things that will happen, and we're at the 12th hour right now. We're down here where, hey, I've got to close the day after tomorrow. And all of a sudden, we're getting addendums that we didn't know existed and create issues that we are going to have to address now. Now, one of the issues, and people have been in the industry for a long time, loved to be able to give flooring allowances, carpet allowances. We used to do that. We used to do it a lot. Someone going to buy a house, don't like the carpet, okay, the seller says, I'm gonna give you $3,000 as a carpet allowance, but I'm not pulling it out of my pocket. When you close on the house, I'll pay the $3,000. We would do it, get it done. We cannot do that. We cannot do that.
How do you do it?
That is a tricky situation. the way that we recommend that people, I'd love your
I've got
input.
3 carpenters on my speed dial that I can call and say, I need a huge favor.
She's
because
good.
I've got plumbers in my speed dial, I've got carpenters, people that can fix a gate, a
But
fence.
how does it solve the challenge that a seller may not wanna change the carpet?
That's
unless
the
they know that
question.
it's
Well, they're
closed?
taking a risk.
They're taking risks.
Because they're all of a sudden, they're putting, that's why you gotta make sure you've got all I make sure that's the only thing holding this deal up financially, is that carpet. But, I mean, and then sometimes, I had a wooden floor, they wanted a wood floor put in, I'm like, you guys, you just added, you can't get a guy to come throw a wood floor in overnight. And
There are ways to get around this, and
What are they?
Oh.
call
no,
Ben. Call Ben.
here's what it looks like.
Nothing shady here.
No, nothing shady. We can't do anything shady. But here's what you can do. Okay, you've generally written a contract that says we're gonna pay $5,000, whatever, dollars per seller plate clothing costs. Well, we get down the road and this negotiated carpet allowance generally comes in after the fact. It's not generally on the front end, because on the front end, we address it right now. So what we're going to do is say, look, you gave me $5,000 seller paid closing costs. I actually have more costs than that. Generally, that $5,000 seller paid closing cost in many instances won't cover all of the closing costs, because closing costs are different than prepaid items. Okay, but you can generally on most programs, you can actually have the seller pay your prepaid items. So here's what you do. I can't do your carpet, but I feel bad that I can't do your carpet. I've given you $5,000 to say pay your closing costs. How about if I write an addendum? I will also pay for your prepaid items. Now with that savings, you can do whatever you want.
Lower the price.
You can lower the price. What
That's the easiest.
Now, what you cannot do, and I want to make sure that they understand I'm saying this, we cannot just hoodwink the fact that now we're going to go through carpet in there. Lower the price, you can do whatever you want with the savings. Increase the paid closing costs, you can do whatever you want with the savings. But I am not coaching you to write a contract so that you can find a way to go get that carpet allowance past an underwriter. We're not doing that. Our profession won't look at that well, yours will not look at that well. But they've got an issue that is not carpet, it's money, isn't it?
Sure.
So here's how we address the money. We're going to give them an allowance, we're gonna lower the cost of the price, and what you do with that money is your business. So those are issues that come up. Just recognize that, the weather-related escrow repairs, that can obviously change throughout the process of doing a loan. You could actually have 3 feet of snow when we took the application, and you have no snow the day of closing, that could cause a problem. That's a for instance.
How about I wanna buy the refrigerator?
Did you want to buy the refrigerator? What we prefer that you guys do is that you handle a bill of sale between you and between the buyer and the seller. And this is one end where I am certainly by no means a real estate expert. You guys are supposed to have every single thing you do encompassed under your Rep C. To go out and say that, my buyers are going to, you could actually say we're including this in the sale of the property.
Doesn't it state that on a
I think it
form?
does.
I thought that it did, doesn't it,
does.
Daryl?
It's
I
recently,
asked the question in hope that I would bring the conversation
it's recently
in
changed.
that if somebody wants to have a separate
Yeah, does the fridge stay or leave?
Well, okay, so
That's on the
here's,
So
first
that
page
was-
of-
That's
Like a
just
swing
whether
set.
it's gonna be, but-
Does a swing
let's
set
go to
stay?
worst case scenario. Worst case scenario is we can't actually put it in the contract, okay? They wanna have that fridge, it's gonna cost $600. Worst case scenario, you're gonna write an addendum that says, I'm gonna buy the fridge for $600. Our underwriter's gonna make sure that you have, after we've done everything with down payment requirements, reserve requirements, that you have the $600, it's not gonna affect the transaction at all. Okay, go ahead.
Okay.
That's worst case. Now, you will find a lot of your transactions don't fit that. They don't have $600 extra. They don't have the ability to have reserves that down payment requires taken care of. So in that case, Now here, I'm gonna go back to, you guys are master negotiators. That is actually something that should have been handled on the front end. This is not a chastisement, this is a warning
It's
that,
on the very first page of the rep sheet, you know, include refrigerator, include microwave, include, you know, you check it or don't check it.
yes,
And, you
Well,
know,
that wasn't what I was meaning, I was meaning.
if you wanna buy it after as a gift,
A separate.
you can now.
What my question was when a buyer said, I realize you're not leaving the refrigerator, but I'd like to buy it from you, in a separate.
Separate
Bill of
transaction,
sale.
bill of sale.
see, and that's an area where I'm not really qualified to,
Usually that's addressed day one,
yeah.
not last day of the whole.
If you bring that information to your broker or to me, I have to ensure that's addressed in a contract.
Don't, because then you just buy yourself a week.
I'm just telling you, you bring that information to me, I cannot wipe it under the table, and neither can your broker.
Okay, that's why I bought it.
So be very careful. I know that in years past, with the real estate contract, we deal with real property. And that they've changed that, haven't they? We now have allowances for fixtures.
I mean, and just recently, you know, you could only spend up to so much as a gift
Yeah.
out of your proceeds. And now out of your proceeds, you can buy a,
Or a home warranty or something.
yeah, and I always build up on warranty.
Exactly, you're covered there.
Every.
Yes. Now, I would like to address, I've said in here that there's some things that I didn't want to talk about in here. It's because I don't know for sure.
Okay, thank you, sir.
I will never, ever advise somebody to do something that is not completely within regulations. Ever. I've done this for 24 years. I've had a license for the majority of that time, as soon as they required one. And I'm not about, for a small little transaction, or to save someone $500, advise them to do something that is against the law. And I highly recommend you don't ever do that either. They send out a quarterly statement telling you the people who have been sanctioned by the divisions who oversee us. They send that out for a reason. Those people lose their licenses, whether for a short period or permanently, for doing simple little things that we thought was just not a big deal. If you have a question, go to your broker. And especially if you have a question about a loan officer doing something that you don't think is accurate, bring it to someone's attention. Because when those things go bad, they cast a net, and it covers everybody when they drag you into a court of law. Protect yourself. You feel someone is doing something that is not right, your license is worth a lot more than that transaction. Always. And I read those things on a regular basis. Every quarter they come out and I go, wow, I didn't realize the magnitude of that infraction. Though I wouldn't have done it anyway, I didn't realize that was gonna cost $5,000 in their license for a year. Now, if you make $100,000 a year, what was the real penalty? So please, understand your laws and regulations, and if you ever feel like someone is actually stepping outside of that, bring it to someone's attention, because you have to protect yourself, you have to protect your client, you have to protect your license, and make sure those things happen. So, any other questions on that kind of stuff? I know as you go along, addendums are a really, they're a complex situation, and if you have any doubts, whatever, go to your team lead, go to your broker. I would also, if you have questions, run it past your loan officer. I'm about to write an addendum here. What do you think the underwriter is going to think about this? Okay,
So all an addendum is just something that's added to the rest of the forms.
yes,
It's just an extra thing.
that's your thing, but it changes the original contract.
There's almost an addendum on every single,
Transaction.
Yeah,
it starts addendum 1, then addendum 2,
Yep.
addendum 3, and almost everyone has at least one. I don't think I've ever seen.
I don't
They can be
either.
real short and then they can be
Absolutely.
real long.
Now-
So it's like, I'm gonna add curtains to the house or.
Or I'm gonna leave the curtains.
Yeah.
Oh, okay, so those are the item, you're just itemizing things that are going or not going with the
Right.
house in the
It
addendum.
could be anything, change of the closing date, change of earnest money, or change of
Due
closing costs.
diligence needs to be extended 3 days.
Standard contingencies. Now, really important on these addendums, I don't know that I can read this in sufficiently. You guys are the ones writing and receiving addendums. We're not. And I can't tell you how many times we're missing addendums. And that will cause this flow, because we generally find out down here, that will cause missed closing dates. Because we didn't know you had another addendum. We didn't know it existed. Or, not just that, you did your job, you wrote the addendum, you had your borrower sign it, and then you shot it off to the listing agent, and you sent me the copy that you sent them, but I don't have their signature on it. Guess what? I'm not closing.
5 o'clock, it just expired and I want your deals.
I'm not closing. So those addendums are hugely important. There are 3 signatures for, depending on how many borrowers, but those have to be on there. They have to be dated properly. The addendum has to be numbered properly. And actually, I've seen numbers and letters, I don't care. I don't think that's an issue. I don't know if you guys, is it
We're not.
mandated numbers? Okay,
Bravo Key and Matt Barton.
okay. Nonetheless, if you don't address those things, your ability to close on time now just went.
In support of you, I was at a class the other day, and the attorney for the board, I think his words were, the difference between an addendum and the contracts is that the contracts are written by an attorney, and we're pretty safe just by filling in the numbers, but the addendum actually just open lines and you write them, so your language can be.
I generally have a broker look at any of my,
Absolutely,
this is something really simple. But
absolutely.
I generally have a broker look and make sure I
Yeah.
did it right.
Now, I want you to understand something as we look down here. What's the urgency level at this step right here? Not really that high. Okay, hey, can you get it done? Can you get your job done in a week? Yeah, probably. What's the urgency level down here? I'm dealing with minutes. I've got to close. And at this step right here, I'm still gonna put people's names down here. Those people aren't waiting around to close your transaction. They're actually, as we get down here, these people are seeing, and so we get down to this process down here, they're seeing 10, 20, 30 transactions a day. And you come in and go, okay, I got it done, go ahead and jump me back in that line. Generally not how it works. Now, your loan officer is gonna say, oh yeah, we'll get it done, and they're gonna go in and try and request a rush, and they're gonna try and get it done. The truth of the matter is, as we introduce variables down here, your ability to close on time diminishes.
I found that too, that if you're trying to do it Friday at 3 o'clock or Friday at 2 o'clock,
Good
and you
luck.
got people at the title company waiting and you're waiting for one,
Good luck.
you're in trouble. If you're on a Tuesday at 2 o'clock, it's probably not that big of a deal.
Yes.
But Friday, I mean, everyone's trying to cram it in, and
When do most people wanna move?
Weekends.
Weekend. So when do you wanna close your deal?
Well, before.
Not Friday. I'm telling you,
early on Thursday.
you guys are writing
Early
the
on
contracts.
Wednesday.
Do not write a Friday contract and think because something's gonna happen. And you think you're gonna close, hey, we're gonna close at 3 o'clock Friday, you're gonna keys at 4 o'clock.
It's not gonna fundamentally record until at least Monday or Tuesday.
So get it done by Wednesday or Thursday at the latest?
I would never, me personally, I just wouldn't write a contract that went, I mean, I would do Thursday, but I would prefer to write Wednesday at the latest. Everybody wants the weekend. Now, if you have someone who's doing a lease back or they're gonna take occupancy past that, then don't worry about it. You're gonna know that in the contract. But someone has to use that weekend, and they do. I would never write a Friday contract. So as you're sitting down and you go, you know what, I wanna do my 30-day, we prefer a little more because there's so much required of us, but as you sit down and say, okay, how long should we give to, for the closing date, and you just pull a number out of your hat, get your phone out and look at the day of the week. Because you might be setting yourself up for a failure down the road. So I would definitely never, ever have my settlement deadline on Friday, ever. So do the best you can, because that's important to set that up on the front end. Okay, so we've now, I don't know if we jump back into that, and I'm fine talking about anything you guys want to talk about. What time is it?
It's 11:20. I just
Okay.
looked.
It's break time for me.
Okay, did you guys want to take a break? And I don't know how you guys do
Aren't
this.
we done until 12?
We do till 12, but did you guys want to grab a drink, go to the restroom? Okay, then we'll just keep going. Okay, so the underwriter now, we've submitted to the underwriter, QC is taking a look at it. We've met the conditions, and this is called resubmittal. Okay, we have now addressed all the issues that the underwriter had, and we're gonna submit that back into them. Now, resubmittal also has a waiting period, because underwriters are very highly paid, very efficient. They're not sitting around waiting for your transaction to show up. I'm sorry, but those are the realities. They also have wait times. So here's what we've done. We've tried to meet all the conditions they asked for, now we've resubmitted them. Here's a very real possibility. The information they asked for, we gave to them, and it created more questions than answers. Now we're back in resubmittal, and she's saying, I want to verify where this earnest money came from. It didn't actually come from their normal checking account, it came from this other checking account, so get me that checking account so I can verify they have actually had that money for 2 months. It's been sourced and seasoned. So we go out and we get this other checking account. And we bring it back and we submit it here to take care of that question. Now they look at the question of that checking account, and it's got NSFs in it, non-sufficient funds. It's got deposits, cash deposits that are, say, $1,000, $1,500. We now have to go out and verify that. The Patriot Act goes back 5, 6 years ago when it really started affecting us. Patriot Act says that we will not be a conduit for laundering money. So when we do a loan for somebody, we have to verify that any funds, unsubstantiated funds that go into their account that we can't trace to either their job or verifiable sources of funds, anything that just cash shows up in there, we now have to verify it. This has happened where we give an account, they verify they had the $500, but $1,000 in cash went in there. Well, where did that come from? They're not just like, oh good, you had that money in the account, we're good to go. You have unsubstantiated cash went into your account, and we have to verify it. So now, we thought coming out of the second review, we're gonna come out of this, we're gonna draw docs, we're getting ready to close, and all of a sudden we have this huge bomb. You didn't have funds that came from a source that was reliable. That problem I just described to you can actually kill a deal.
So if somebody gets a bonus on a check, that's
Verifiable,
okay.
verifiable, became
So
free
if it
job,
was a gift from a parent,
verifiable. As long as their account
so
and
what
also
wouldn't be?
cash that just came from, you know what, here's the
So the
situation.
Joe Blow.
It's sitting
Joe
there.
Blow. Look, I have to verify that I had $500 in my account, I can't verify. Hey, Jimmy, will you loan me $1,000 so I can just put it in my account? Go in, $1,000 goes in, underwriter says, where did that come from? See, we have to source and season funds. Source means where did it come from? Season means you've had it for 2 months, okay? Seasoning can trump source if you have it for 2 months. We've had to have transactions sit and wait the 2 months because they didn't have reliable sources to get their money from. This goes back to the Patriot Act. Are we running money, are we laundering money for, now I think there's a lot of paranoia involved in that. Are we laundering money for terrorist cells? No, I didn't just buy a condo for $80,000 to launder money for the ISIS. Nonetheless, that happens. Okay, let's say that we meet all the criteria. We've answered all the questions, we resubmitted it, the underwriter says everything's good, okay? Now, we're going to go to the doc jar. Okay, this person is going to draw up all the documents required to close the transaction. Any idea how many documents there are? I'm not sure how many, but it looks like this, okay? And every one of those documents have to be 100% correct. So now, luckily we have software that really helps us. We plug in the numbers that are relevant, and it kicks out the docs. But this doc jar, they're also not just sitting here at their desk saying, hey, please give me something to do. Doc jars do more work than they do. They're going all day long. And here's the interesting thing about doc jars. This just happened this year. Used to be last year, hey, get me out of underwriting, get me out of underwriting, draw docs and close. Okay, it doesn't happen anymore. We now have what's called a CD, which is called closing documents, but you'll hear everybody say CD. CD is, the laws relevant to the CD says that the borrower must see that CD and they have to acknowledge signing that. They can do that electronically. But if they do it by mail, it changes the game. If they acknowledge electronically that they've received that document, they can close 3 days later. 3 days later. That's part of the new federal regulation, is that you as a borrower has the right to view those documents for 3 days prior to closing. Now, if it's a refinance, which as agents, you don't necessarily deal with that, but as individuals you do, after those 3 days of the CD, then you have 3 days of rescission on a refinance.
After all that, they can still rescind.
Yes, on a refinance,
Oh.
not on a purchase. Purchase, you have your 3 days and then you decide. Now, I have to tell you though, if someone wants to rescind, what are we gonna do?
Okay, so does that apply to everybody, that they have 3 days to read that big stack if
Yes.
they want to?
Yes.
Okay, so what percentage do you ever find them taking that long to read word for word? Because I know that those things are long.
I don't know that anybody reads them,
That's my point.
but the law requires that they have 3 days.
Okay.
And this is so
It's your choice
important.
whether you read it or not.
It's your choice whether you read it or not. Now, let me tell you what, and this is probably the most important of this entire thing we've been talking about for an hour and a half. We're gonna bust our tails to get out what's called an early CD, okay? An early CD means that we have a really good idea of what the numbers look like. I mean, we may be back in here trying to verify a couple of documents, but we know what the transaction looks like. We've detailed we know the insurance, we know the title, we know the costs associated with the loan. At this point up in here, we can request an early CD. Now, we have to have seen the appraisal, we have to have seen a lot of other things. With that early CD, it means that, and this is really cool, somewhere up in here, I'm gonna order an early CD. And I'm gonna let my borrowers look at that for 3 days, okay?
Good
Now,
timing.
if I ordered up here and my closing is down here, I'm not waiting 3 days down here. I've disclosed to them that early CD. So that I can potentially close the next day because they've had that CD to look at for 3 days. Now, here's the very most important thing. And it's really cool, but it's got a catch to it. When I send that CD out, those borrowers, and if there's 2 of them, they both have to open, electronically acknowledge it. If they don't, so I have my people bust their tail and it gets over to your house at 6 o'clock on a Thursday or Tuesday night. And you just go, you know what, it's here, we're good, I'm gonna open it in the morning. That's when it's acknowledged the next day, not Tuesday. And now you're closing Monday because you didn't acknowledge it. Now, the loan officers have an obligation to make sure that when that CD goes out, they go in and open it and acknowledge it. But they, on occasion, may need your help as an agent to ensure that they do that.
Okay, now I got another question.
Okay.
I know I'm full of questions, but this is good for me. If at the QC, when you're going to give them all of those docs, what if something happens at the last underwriter when she's got different things going on? And they've already seen all of these for the posted 3 days before your closing day
Right.
with, oh, do you know what I'm,
I do.
I don't know
They
if
could
I'm saying
potentially
that
kill it.
right. So I don't know
Happens
if
very
they're
rarely.
seeing everything that may not be there at the very last day.
What we're trying to do here is once we know what those, we feel really confident that those numbers are right, we can send that CD out.
And save the 3
And
days.
say, well, we're still doing 3 days, it's just we send it out early.
Right, you're saving 3 days at the end.
Yes, but the law was written so that they can look at this. And the law was meant, here again, I'm not saying anything that's, we abide by the law, but the law was written that they assumed we would issue the CD here.
Right.
But they've given us the allowance to issue it here. It wasn't initially written this way, but as we moved into it, we figured out, well, what we have to disclose to them, we know here, so let's issue it as soon as we possibly can. Let's not wait until the last day and then issue it. So it basically was an understanding as we grew into the compliance, this is how it works. But so you bring up a really good question. We issue it here, underwriter finds something down here that says it changes that document. We're starting over.
Ah,
Now, that's how the rule is meant to be, that it would never come out until we knew every single number. Well, we do know the numbers, but a condition could happen, something could happen. This is just an allowance to help us get to that step further. But if it doesn't happen, we're going to have to reissue. Now, I will tell you this, happens very rarely. Because we as a company, we're not going to waste our time and a valuable employee to issue an early CD when there are variables that have not been addressed. So they may come to us at this point and say, issue us an early CD so we can do it. And we're gonna go, you have not done this. We're not issuing the early CD. And you'll end up with it down here. So we are not going to waste our time and our valuable resources creating those things if we don't know that they're gonna actually survive the additional steps. And that is what the federal regulators have meant to happen. We're not changing that step there. So that's what we've done now is we've issued that early CD and they have to acknowledge it. Now, if they do it electronically, there's a 3-day wait period. If they choose not to do it electronically and they just want to print it and wet sign it, it's a 6-day. Nobody ever does that, just so you know. We don't want anyone to ever do that. It's a 6-day wait because they're assuming that it's going to take them that long to get that back to us. So I've given them that window. So on our end, we're just going to make sure that's happening. Remember, getting back to why am I telling you guys this? Because as these things happen, instead of taking a can of gasoline and throwing it on the fire and saying, my loan officer is the worst person that ever lived, I don't know why we're using them, and the borrowers just get all excited and worried about the transaction, you can explain to them, look, what's going on here is a hugely regulated, very intense process. And we have to actually cross every T and dot every I. This will help you to be able to go to your clients and bring it some calmness to have you guys done transactions in here? I know you have. Done some transactions? Let me just tell you, if you do 5 transactions, 3 of them have a fire, to varying degrees.
Let's say that again.
If you do 5 transactions, 3 of them have a fire, to varying degrees. Some fires are just a road bump. Some of them could potentially kill the deal. And if you bring a can of water, you're going to retain client relationships. You're going to retain a relationship with your lender. And hopefully we're going to get through this. But what we do in our professions, both of us, is we handle problems. And the problems don't end when they sign a rep C. Going all the way back to what we talked about at the beginning. You're starting out at the bottom. That's where we enter. We're at the bottom of the production scale. We don't want to work with people at the bottom of the production scale on the loan officer. So how do I get my line to travel this way and work with more competent loan officers? This is how you do it. When problems arise, and they will, you become a solution to the problem. If you become a part of the problem, that loan officer, as we move up the scale over here, will not take your phone calls in the future. Contrary to what anybody might say is that you go out and you pick your loan officer and you just determine who you're going to work with. Trust me, you throw gasoline on a fire and you want to work with one of these competent loan officers up here, they will not return your phone call. So you want to not work with the people down here who are learning the business and actually do 10 transactions a year, which certainly doesn't qualify them as an expert. Become a part of the solution. So when fires happen, when issues like this come up, help them understand this is a very difficult process. Our country went through a mortgage crisis. Trillions of dollars were lost. Trillions. There is a 3,000-page document, CFPB came out, the Dodd-Frank Act, 3,000 pages addressing finance regulations in this country. We are now implemented up to, I think, is about page 800. The remaining document has not been implemented. That's how much of a mortgage crisis we've been in, a financial crisis, really, to take into consideration. So when we talk about what is it going to take for me to get through the transaction, you'll have fires. There's a couple other steps down here. I want to finish this out. We're going to do this real quick. Dock jar does this, sends the docs out. We've got a funder. Well, you know what? I'm talking mortgage here. Obviously, the title company is in here closing your transaction. They get the documents back to us. The funder looks at those documents, makes sure everything is in place. Then they fund the transaction. Okay? Meaning that your borrowers get the keys, you get a paycheck, everybody goes along happy. After this step right here, we have a process called post-funding. And post-funding is one of the most important positions in the entire process. The reason why is this. Citywide, we are a mortgage banker, meaning that we close a transaction in our name, and we fund that transaction. Almost immediately, we sell that transaction to an aggregator. Aggregator is a servicer of mortgages. So they're gonna take the mortgage, they're gonna service it for however long, they may sell it to someone else. But we have funded that with our own money in anticipation of selling that to an aggregator. Okay, when we fund it, we use a warehouse line. Warehouse lenders don't wanna get stuck holding the bag on these. So they have someone who looks at this file, okay? Then when we send it off to the aggregator, they have someone who looks at this file. Remember, we funded it. And when funding happens, the rush is over. Remember that? So down here, we're scrambling to make sure that that deal stays bought. And here's what happens, because we have underwriting guidelines. And that's supposed to be the hard and fast rule of what happens in the lending industry. Truthfully, here's where the rules are. When we send a file off to an aggregator, and they come back and say, here's your deficiencies, address them. We have to now come back up here and say, okay, that's an issue, address those deficiencies. And they have to try and bring that into the underwriting process, or we end up owning files. So once that happens though, we send that off to the aggregator. The aggregator actually has how long before they can come back on us? 30 years. Doesn't have anything to do with you or your borrowers, but we could potentially buy that loan back at any time during the process of them paying for it, at any time.
Within 30 years?
Well, I say 30 years because they're paying for it. Once they paid it off, there's no obligation.
And they can sell that too to
They
somebody
can sell it
else.
to someone else.
And
But-
do.
And they do. They do sell that. But that loan could actually come back to us, the lender, at any time before it's paid off. So the reason why this is relevant for you guys, you're gonna get down to the end, it's gonna look, we got a deadline to meet, I'm gonna lose all this money, close this deal. As a lender, we're going, we have to make sure every single thing is done, or we buy that loan back. And we do buy loans back. It's not a lot of them, but we do buy loans back. And you either service them, or you do a scratch and dent. You discount it, just like any kind of commodity, you discount it and sell it on the open market.
So is it a loss to you? or
Absolutely. Absolutely.
When you have to resell the same thing over?
Yes. Or we're gonna take a loan that we originated at 3.5, and the owner's gonna take his money and put that in there, a 30-year instrument of 3.5% return.
What do you do with all the losses that you acquire? I mean,
Cost of
hopefully you
doing
don't,
business.
but
Hopefully there's
What?
more wins than
Cost of
losses.
doing business. When you go into the store and pick up a loaf of bread and it's $2, a portion of that $2 is calculated for the cost of theft. It's cost of doing business.
Spoilage or.
And you will actually, now, we're not gonna go into this today, but actually, interest rates are tied to those losses. We're actually still paying for some of the losses that were made in 2007 and before. For instance, if you guys had followed FHA very closely, the mortgage insurance, the upfront mortgage insurance and the monthly mortgage insurance have both shot up in an era in which we're writing the strongest loans we've ever written, because they're paying for the cost of foreclosures. So the losses are generally shot back to the consumer. In our case, we're a small player considering the national stage we're playing on. You know what? We scratch and dent them. You take a 20-30% loss on the deal and you sell it. That's the cost of doing business. So the reason why that's relevant to you though is because you're on the outside looking in and saying, close my deal. We have 2 days, get it done. This is what's going on behind the scenes. And as new agents, if you want to deal with good loan officers, you throw a fit, scream and yell, make your borrowers angry at that loan officer. If they're not very good, my recommendation is get yourself through the transaction and find someone else. But if they're a good loan officer and the best, you brought up a good point, the best have problems. That's the nature of the business. And you want to deal with the best, become a part of the solution. not part of the problem.
One of the things, and I advocate for citywide pretty heavily, but I ran into a couple deals ago. So the people I was dealing with, they were comparing my loan officer and the people with their own bank.
Right.
And their own bank was saying, look how much higher the closing costs are gonna be at citywide versus here.
Sure.
And I didn't have an answer for him. So I call his boss, who happens to be a close friend of mine. He says, well, what's their origination fee? And they had an origination fee. Origination fee is really a kink in a sense, because then they get their money either way, even if it, but so citywide, if that, make sure I'm correct in saying that, citywide doesn't have an origination fee. And so, but when it's all said and done, they were within minuscule dollar or two of each
Just
other.
identify which each one.
But if you do it as an origination fee, they're gonna get their money and they're not gonna give it back if, you know, cause they've got it.
Yeah.
Citywide doesn't do an origination fee,
Right.
so the
I don't
closing costs, and I stuck my foot in my mouth on that one. And I needed to have that explained to me. I thought I knew a lot of things, but that was an
I
original.
don't think there's ever been a more competent group of people gathered together in one building in the city.
I appreciate that.
So where does the origination fee start with your list? Where do you, what is it for?
Well, origination fee is how this individual gets paid. Okay, so.
But if you don't have it, so how does that elevate
Okay,
it?
so there are two ways to actually consider the means in which they'll be paid. So we can charge origination fees here, or the aggregator we're selling the loan to can pay them for us
That's at the very
at
bottom.
the bottom, yes. So you could potentially, if you went out and paid the origination fee, now it technically becomes a discount, you're buying the rate down. So you could
Yeah,
potentially
That's another thing.
that one, just so you know, I don't know that I would, I mean, you guys are drinking out of a fire hose right now. I mean, if you want me to come back and talk on another day, I'd be glad to. But the information I've given you is overwhelming. Even in people in our industry, as we talk about this, some of this stuff they don't recognize. I wanted you guys to basically get, what I wanted you to understand is that the process of getting a loan through is very complex, very intricate, and that you need to understand that so that when you run up against issues, lending, that you don't become a part of the problem, that you try and figure out a way to get that deal through closing.
So are you gonna teach another class about the points and the interest and all that stuff?
We haven't scheduled it, but you know what? If you guys want it, we
I
can do it
asked
anytime.
millions of questions because I need to know. I don't know, nobody else has asked any questions,
If
so
you want to
I'm
do
hoping
that,
I asked for them.
I am fine. It probably wouldn't be during Russ's Tuesday and Thursday class. I'm fine to come in and teach this. If you guys want to gather a few people, we can come in and talk about some other stuff like that, and that would be fine. I'd be more than glad to do that. I will tell you this, for you guys, this represents 24 years of me being in the industry, of knowing this. And I hope this doesn't sound bad, but most of your loan officers couldn't come over and, you know, I'm the branch manager over here. Not most,
A
but
lot of
a lot of
yours,
our
though.
loan officers couldn't go through that in depth. There's, the really good ones up here can, they get it. In fact, the really good ones, they know underwriting guidelines. The really good ones. They know.
A loan officer.
Your underwriter and your loan officer's relationship
Oh, it's
is key.
powerful.
But I would also say to everybody, have two loan officers. You know, because mine was who was citywide, he went to Cabo for 2 weeks.
Yep.
And so I had Phil Fiddler, another loan officer. So I've got two citywide loan officers. So if one's busy or one's slammed or can't take my call the second I need
That's right.
I call the other one. And
That's wise, you know, don't throw your eggs in one basket.
yeah, I have my favorite and then I have my second favorite.
Absolutely.
But don't always just have just one.
I agree. Okay, that's basically in a nutshell what we were trying to present today. More than glad to come back and talk about additional things. I do come in at the first of all of Russ's meetings and we talk about things that are important. We can do, I don't know if a 10-minute thing, Russ generally gives me 10 minutes. That may work to cover those things.
What are rates doing right now?
Right now, they're jittery. We're pre-election and the financial markets are always a little bit concerned about what's going to come out of that. So they're jittery. They're still, for conventional, we're still mid-threes. I honestly don't know what we're going to come out of the election with.
Neither do we with whoever's the president.
Janet Yellen has all the control.
I'm telling you right now, if Janet Yellen gets more authority, we're in trouble.
Yeah.
And I don't know if the Democrats have any intent of putting her in any position of authority in their cabinet. I don't know.
Didn't she say that she's on the verge of raising it just a hair?
Well, that's a good thing.
Oh, I'm sorry. You know what, Janet Yellen, FedEx. I'm thinking of the Boston Gal.
Secretary of Treasury.
Right. Janet Yellen. Actually, I'm
Elizabeth
actually
Warren.
Elizabeth Warren. Actually, I like Janet Yellen. She's growing into her job.
And she's not political.
She's not political. Elizabeth Warren, if she becomes a part of the cabinet, be aware, she wants to implement the entire CFPB 3,000 pages.
She wants to do what?
Implement all of it. She says there is not enough regulation.
Really?
Yeah. So, anyway, we if you would like to, in fact, I would appreciate this, if you guys have issues that you want addressed, because I'm always up here on the 10-minute thing, I'm always going, okay, what would be relevant to you guys, what is important, what would help
How
you?
long do you have after 10 minutes?
Russ says he would like it. He says if people ask questions, then we can go longer.
Did I ask questions, you guys?
I think she did, yeah. But if you guys have issues you want covered, I come in every Tuesday and Thursday. So if you want me to cover additional things, it would be helpful to me so I know what you want to learn more of. So that's all I have. Is there any other
That
questions?
was very good, thank you.
Is everybody okay? Okay, thanks for coming.
Very
Thanks for showing up. Hope it helps you. And I want you guys to understand real quickly, I'm a non-producing branch manager. If you have questions, you don't have to worry about me giving you a sales pitch when I'm gonna start hounding you. Literally, you can ask me a question with no ulterior motive. I'll try and find an answer for you. If you ever want someone, I know people I can get you with, but if you're just looking to ask for a question, answer, by all means, come and talk. I'm just across the hall over here. That everybody got signed up? Okay, thanks, guys.
Thank you.
Thank you.
Okay, so for Tony, is there any does he doesn't have, he doesn't talk to me the title?
So you got some of this on the you can enter forward. Or he's taking an application, so you've written a contract, is that what you're saying?
Yeah, so I sent you a contract.
Oh, so it's over, it's here?
Yeah, it's on one.
No, Steve Ames probably.
Oh, okay, I'm sorry.
Okay, so what he's supposed to do is he's getting now the loan estimate is supposed to go out and be signed, and once that's signed, they can order the appraisal. So I don't know if the loan estimate's done that, give me the name, I'll check on it. What's the name of the borrower?
That's only a one. So it doesn't have anything to do with him, getting such a time, because I think you were saying something about stuff has to be done before you guys can order an appraisal.
Yeah, so what has to be done, is we just have to gather the documentation enough sufficient, we can issue the loan. That's done by email. When they look at that, they go in and it asks them to e-sign. Once they e-sign, then we can move on.
So what's a loan estimate?
Loan estimate actually takes, it's our estimate of the cost to do business.
Okay.
So.
Yeah, I don't know if he's got that yet.
And the reason why he may not have that done yet is because they're still in the process of gathering information. The reason why we would slow down on a loan estimate is because when we issue those estimates, we have to abide by them. Well, we're trying to gather as much information about the borrower because his financial situation will determine what loan we can do. And if we're still trying to gather that information to determine which loan it is, we can't issue it prior to that because it might change.
Okay, so is that something that I would be concerned with, or is that just something Steve takes care of?
No, he will take care of it.
Oh, so I don't even need to worry about it?
No,
Oh,
no, he's in the process of gathering that information. And,
His processor.
his processor is helping him. His loan officer assistant is doing that gathering.
Thank you.
So, yeah, if you have any questions, please don't hesitate to ask me.
Thank you.
Thanks for coming. You know, I don't know that this,
This doesn't you gotta spray.
oh, you do? You have to spray?
Don't worry about it.
Well, I don't have a problem with it. Oh, it just doesn't wipe, does it? You gotta do it like that. Hey, thanks for being in here. That was
Well,
helpful.
I'm trying to, go get my broker stuff, and I wanna make sure I thought, what better than to go through Russ's course before as I'm getting my broker,
So you're gonna get your broker's license?
that's like,
See, I thought you had your broker's license.
see, and that's, I kind of have maxed out where I could go as a manager. I don't have enough points, I don't have,
Points that the division requires.
the points division and time.
Oh, okay.
And
Okay.
so I pulled myself out of the management team and just focusing on real estate. It's not that.
Or do you know?